morning, ladies and gentlemen, and welcome to Forex Trading Beginner class. I will be your facilitator for this program, and my name is Halilu Ahmed Samuel. So we are going to cover about 9 topics in our Forex class for this free 5 days. So before that, please, these are my details in which you can use to contact me and follow me. My Facebook account is here, my YouTube account, my Gmail address, my Telegram address, my Twitter account, and my WhatsApp number are all clearly written here. So the 9 topics we'll cover in our Forex beginner class, which are free, are 1. What is Forex? 2. How do you trade Forex? 3. When can you trade Forex? 4. Who trades Forex? 5. Why trade Forex? 6. Margin Trading 101. Understanding how your margin account works. 7. Broker 101. 8. 3 types of analysis, and 9. The types of charts. Without further ado, let's move into our first part of our Forex beginner class. What is Forex? So, what is Forex? Quite simply, it's the global financial market that allows one to trade currencies. If you think one currency will be stronger versus the other and you end up correct, then you can make a profit. Once upon a time, before a global pandemic happened, people could actually get on airplanes and travel internationally. If you've ever traveled to another country, you usually had to find a currency exchange booth at the airport and then exchange the money you have in your wallet into the currency of the country you are visiting. You go up to the counter and notice a screen displaying different exchange rates for different currency. An exchange rate is the relative price of 2 currencies from 2 different countries. You find Japanese yen and you think to yourself, wow, my dollar is worth 100 yen and I have $10. I'm going to be rich. Or you find out that $1 is about 400 naira. When you do this, you essentially participated in the Forex market. You've exchanged one currency for another. Or in Forex trading terms, assuming an American visiting Japan, you've sold dollars and bought yen. Before you fly back home, you stop by the currency exchange booth to exchange the yen that you miraculously have remaining in Tokyo is expensive, and notice the exchange rate have changed. It's these changes in the exchange rate that allow you to make money in the Forex exchange market. So what again is Forex? The foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world. The FX market is a global, decentralized market where the world's currency change hands. Exchange rates change by the second, so the market is constantly in flux. Only a tiny percentage of currency transactions happen in the real world, involving international trade and tourism, like the airport example above. Instead, most of the currency transactions that occur in the global financial market or foreign exchange market are bought and sold for speculative reasons. Currency traders, also known as currency speculators, buy currencies hoping that they will be able to sell them at a higher price in the future. Compared to the measly $22.4 billion per day volume of the New York Stock Exchange, we will call NYSE, the foreign exchange market looks absolutely ginormous with its $6.6 trillion a day trade volume. That's trillion with a T. Let's take a moment to put this into perspective using buildings. The largest stock market in the world, the New York Stock Exchange, NYSE, trades a volume of about $22.4 billion each day. If you use the building to represent the NYSE, it looks like a one-story building. Looks intimidating, looks like it works out. Some may even find it sexy. You hear about the NYSE in the news every day, on NTA, on CNN, on BBC. Heck, you even probably hear about it on your local bar. The NYSE is up today, blah blah. When people talk about the market, they usually mean the stock market. So the NYSE sounds big, it's loud, and it likes to make a lot of noise. But if you actually compare it to the forex market, it will look like this. Now you can see how measly looking the NYSE looks like compared to the major forex market, which is so massive out there. Oh, the NYSE looks so puny compared to the forex market. It doesn't stand a chance. There's a clear size difference, almost 300 times bigger. Makes you wonder if the S in NYSE stands for stock or for scrolling. Check out the graph of the average daily trading volume for the Forex market, the New York Stock Exchange, Tokyo Stock Exchange, and London Stock Exchange. The currency market is over 300 times bigger. It is huge, but hold your horses, there's a catch. Here's a chart to show you the FX market, how big it is and compared to the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange. The huge $6.6 trillion number covers the entire global foreign exchange market, but the spot market, which is a part of the currency market that's relevant to most forex traders, is smaller at $2 trillion per day. And then, if you just want to count the daily trading volumes from retail trader, that's us, it's even smaller. It's very difficult to determine the exact size of the retail segment of the FX market, but it's estimated to be around 3 to 5% of the overall daily FX trading volumes, or around $200 to $300 billion, maybe less. So you see, the forex market is definitely huge, but not as huge as the others would like you to believe. Don't believe the forex is a $6.6 trillion market hype. The huge number sounds impressive, but is a bit misleading. We don't like to exaggerate, we just keep it real. Aside from its size, the market also rarely closes. It's open virtually around the clock. The forex market is open 24 hours a day and 5 days a week, only closing down during the weekend. Want a bunch of slackers. So unlike the stock or bond markets, the forex market does not close at the end of each business day. Instead, trading just shifts to different financial centers around the world. The day starts when traders wake up in Auckland, Wellington, then move to Sydney, Singapore, Hong Kong, Tokyo, Frankfurt, London, and finally New York, before trading starts all over again in New Zealand. In the next section, we'll review what exactly is traded in the forex market. So what is traded in the forex market? The simple answer is money, specifically currency. Because you are not buying anything physical, forex trading can be confusing, so we'll use a simple but imperfect analogy to help explain. Think of buying a currency as buying a share in a particular country, kind of like buying shares in a company. The price of the currency is usually a direct reflection of the market's opinion of the current and future health of its respective economy. In forex trading, when you buy, let's say the Japanese yen, you're basically buying a share of the Japanese economy. You are betting that the Japanese economy is doing well, while it will even get better as time goes. Once you sell those shares back to the market, hopefully you end up with a profit. In general, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other economies. By the time you graduate from this school of forex trading, you'll be eager to start working with currencies. So, the major currencies. While there are potentially lots of currencies you can trade, as a new forex trader, you'll probably start trading with the major currencies. So these are the charts to show you all the major currencies are in the world. They are called major currencies because they are the most heavily traded currencies and represent some of the world's largest economies. Forex traders differ on what they consider as major currencies. The uptight ones, who probably go straight A's and followed all the rules as children, only consider United States dollar, which is USD, the European euro, which we call EUR, the Japanese yen, which is called JYP, the Great British Pound, which is GPY, and the Swiss franc, which we call the CHF, as major currencies. Then they label the AUD, which is called the Australian dollar, the NZD, the New Zealand dollar, and the CAD, the Canadian dollar, as commodity currencies. For us rebels, and to keep things simple, we just consider all 8 currencies as the majors. Below, we list them by their symbol, a country where they are used, currency name, and cool nicknames. So these are the code: USD, Euro, the 8 of them, and I told you, United States, Eurozone, Japan, Great British, Switzerland, Canada, Australia, and New Zealand. As you can see, the USD is United States dollar, the Euro is the Euro, JYP is Japanese yen, GPB is Great Britain pound or Great British pound, the Switzerland franc is a CHF, the CAD is the Canadian dollar, the AUD is Australian dollar, and the NZD is the New Zealand dollar. Also, here are the nicknames of these major 8 currencies: the buck for euro for dollar, the fiber for euro, the yen for the yen, the cable for the pound, the Swizzy for the franc, the loonie for the Canadian dollar, the Aussie for the Australian dollar, and the Kiwi for the New Zealand dollar. Currency symbols always have 3 letters, where the first 2 letters identify the name of the country and the third letter identify the name of the country's currency, usually the first letter of the currency's name. These 3 letters are known as the IOS 4217 currency codes. In 1973, the International Organization for Standardization, which is the IOS, established the 3-letter codes for currency that we use today. So here's a sample of the New Zealand dollar: the NZ for New Zealand and the D for dollar, so country name and currency name. Take NZD for instance. NZD stands for New Zealand, while D stands for dollar. Easy enough, right? The currencies included in the chart are called the majors because they are the most widely traded ones. We would also like to let you know that the buck isn't the only nickname for the US dollar. There's also greenbacks, bones, Benjis, Benjamins, cedar, paper, loot, skrilla, cheese, bread, mullah, dead president, and cash money. So, if you wanted to say, I have to go to work now, instead you could say, yo, I gotta bounce. Gonna make them Benjamin's son. So, fun facts: in Peru, a nickname for the US dollar is Coco, which is the pet name for George which is George in Spanish, in reference to the portrait of George Washington on the $1 note. Trivial fact: did you know the British pound is the world's oldest currency that's still in use, dating back to the 8th century? The newest currency in the world is the South Sudan pound, made official in July 18th, 2011. So part C of our class 1, buying and selling currency pairs. Forex trading is the simultaneous buying of one currency and selling another. Currencies are traded through a forex broker or CFD provider, and they are traded in pairs. Currencies are quoted in relation to another currency. For example, the euro and the US dollar, which we call EUR/USD, or the British pound and the Japanese yen, which is called JBP/JPY, or GBP/JPY. When you trade in the forex market, you buy or sell in currency pairs. Imagine each currency pair constantly in a tug of war with each currency on its own side of the rope. An exchange rate is the relative price of two currencies from two different currencies. Exchange rates fluctuate based on which country is stronger at the moment. So there are three categories of currency pairs: the majors, the crosses, and the exotics. The major currency pairs always include the US dollar. Cross currency pairs do not include the US dollar. Crosses that involve any of the major currencies are also known as minors. Exotic currency pairs consist of one major currency and one currency from an emerging economy, which we call EM. Major currency pairs. The major currency pairs listed below are considered the majors. These pairs all contain the US dollar USD on one side and are the most frequently traded. Compared to the crosses and exotics, price moves more frequently within the majors, which provides more trading opportunities. The majors are the most liquid in the world. Liquidity is used to describe the level of activity in the financial market. In Forex, it's based on the number of active trading, buying and selling a specific currency pair and the volume being traded. So here is a chart of the majors and their geek name. So as you remembered, EUR is the euro and the USD is the dollar. So currency pair EUR/USD is also called euro dollar. So USD/JPY is called dollar yen. GBP/USD is called pound dollar. USD Swiss franc is called dollar Swissy. USD CAD is called dollar noni. AUD USD is called Aussie dollar. And NZD USD is called Kiwi dollar. The more frequently traded something is, the higher its liquidity. For example, more people trade the Euro USD currency pair and at higher volumes than the AUD USD currency pair. This means that the euro dollar is more liquid than the Aussie dollar. Major currency crosses pairs or minor currency pairs. Currency pairs that don't contain the US dollar, that's the USD, are known as cross currency pairs, or simply as the crosses. The major crosses are also known as minors. Why not as frequently traded as the majors? The crosses are still pretty liquid and still provide plenty of trading opportunity. The most actively traded crosses are derived from the three major non-US currencies: the euro, the Japanese yen, and the Great British pound. So here's a chart showing you some of the major currency crosses, or cross currency or minor currency. So we have the euro Swissy, Euro Pound, Euro Loonie, Euro Aussie, Euro Kiwi, Euro Stocky, and Euro Noki. We also have yen crosses, which we call the Euro Yen or UP, the Pound Yen or Gopi, the Swiss Yen, the Loonie Yen, the Aussie Yen, and the Kiwi Yen. For pound crosses, we have the Pound Swiss, Pound Aussie, Pound Loonie, and the Pound Kiwi. Some other crosses include the Aussie Swiss, the Aussie Loonie, the Aussie Kiwi, the Loonie Swiss, the Kiwi Swiss, and the Kiwi Loonie. Now, exotic currency pairs. No, exotic pairs are not exotic belly dancers who happen to be twins. Exotic currency pairs are made up of one major currency pair with the currency of an emerging country, such as Brazil, Mexico, Chile, Turkey, or Hungary. The next chart contains a few examples of exotic currency pairs. When I take off shots at guessing what these other currency symbols stand for, depending on your forex broker, you may see the following exotic currency pairs, so it's good to know what they are. Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually higher. We have the dollar real, which is the United States dollar and the Brazilian real. We have the United States and the Hong Kong. We have the United States and the Saudi Arabia, which we call the dollar real. We have United States and Singapore, which we call dollar sing. United States and South Africa, which we call the dollar rand. United States and Thailand, which we call the dollar baht. United States and Mexico, which we call the dollar mex. United States and Russia, which we call the dollar ruby or bani. United States and Poland, which we call the dollar zlotys, and the United States and Chile. It's not unusual to see spreads that are 2 or 3 times bigger than that of euro dollar or dollar yen. Due to the overall lower degree of liquidity, exotic currency pairs tend to be far more sensitive to economic and geopolitical events. For example, a political scandal or unexpected election results can cause an exotic pair's exchange rate to swing violently. So if you want to trade exotic currency pairs, remember to factor this in your decision. For those of y'all who are really mesmerized by exotics, here's a more comprehensive list. For your benefits, I'm going to zoom in and leave it for some seconds so you can appreciate them. So you can see some of them here. We have the UAE Bahrain, Afghanistan Agani, Malaysian Rig, Guyanese Dollar, Aruban Florin, Omanan Rial, Iraqi Dinar, Bahrainian Dinar, Argentinian Peso, Jordan Lari, Armenian Dram, Mozambique New Metikal, Indonesian Rupiah, Azerbaijan New Manat, Qatari Rial, Iranian Rial, and there's still more. As you can see, so many currencies, exotic currencies to choose from. I'm going to leave this for you to see for some seconds so you can familiarize yourself with them. Let me slowly adjust to the next chart. There's so many of them, so many exotic currency pairs to choose from. These are just a few from the many. Aside from the 3 main categories of currency pairs, there are other groups of currencies that are thrown around in the forex world which you should be aware of. The G10 currencies. The G10 currencies are 10 of the most heavily traded currencies in the world, which are also 10 of the world's most liquid currencies. Traders generally buy and sell them in an open market with minimal impact on their own international exchange rates. Aside from the three main categories of currency pairs, there are other groups of currency pairs that are thrown around the forex market you should be aware of. And just let me put that as a reminder. So you can see the G10 currencies are the United States dollar, European Union euro, United Kingdom, Japan, Australia, New Zealand, Canada, Switzerland, Norway, Sweden, and Denmark. The Scandis. Scandinavia is a sub-region in Northern Europe with strong historical, cultural, and linguistic ties. The term Scandinavia in local usage covers the three kingdoms of Denmark, Norway, and Sweden. Together, their currencies are known as the Scandis. Back in the day, Denmark and Sweden established the Scandinavian Monetary Union to merge their currencies to a gold standard. Norway joined later. This meant that these countries now had one currency with the same monetary value, with the exception that each of these countries minted their own coins. But then, World War I happened and the gold standard was abandoned and the Scandinavian Monetary Union disbanded. These countries decided to keep the currency even if the values were separate from one another, and this remains the state of things. If you notice their currency names, they all look similar. That's because the word kron or krona literally means crown, and the difference in spelling of the name represents the difference between the North Germanic languages. Crown currencies, what a cool name, huh? I don't know about you, but saying hook me up with some crowns, yo, sound way cooler than hook me up with some dollars, yo. Here are the three countries and their country code. Denmark, Sweden, Norway. Different spelling. Denmark is the country currency code is DKK, Sweden is SEK, and Norway is NOK. The SEK and NOK also have cool nicknames, which are Stuki and Nuki. So when paired with the US dollar SEK is read dollar Stuki, and US dollar NOK is read dollar Nuki. CEE currencies. CEE stands for Central and Eastern Europe. Central and Eastern Europe is a term encompassing the countries in the Central Europe, the Baltics, Eastern Europe, and Southeast Europe, the Balkans, usually meaning former communist states from the Eastern Bloc. We call it the Warsaw Pact in Europe. Central and Eastern European countries, CEECES, is an OECD term for the group of countries comprising Albania, Bulgaria, Croatia, the Czech Republic, Hungary, Poland, Romania, the Slovak Republic, Slovenia, and the trio Baltic states, Estonia, Latvia, and Lithuania. Regarding the FX market, there are four main CEE currencies to be aware of. From this chart here, this table, you can see the different countries, their currency name, and their currency code. The BRICS, the BRICS, is the acronym coined for the association of five major emerging national economies: Brazil, Russia, India, Indonesia, China, and South Africa. Originally, The first four were grouped as BRIC or the BRICS. BRICS is a term created by Goldman Sachs to name today's new high-growth emerging economies. BRICS is the term created by the OEC when it added Indonesia and South Africa. Here you can see the different BRIC countries and their currency name with the currency code. So summary, that was a lot of information on currencies that just raised your forex IQ points. So let's summarize what you've learned in a series of questions. What is a currency pair in forex? A currency pair is a pairing of currencies where the value of one is relative to the other. For example, Great British Pound US dollar is the value of the British pound relative to the United States dollar. What are the major currency pairs? Major currency pairs, the majors, are those that include the United States dollar, the most frequently traded. There are 7 of them: the euro dollar, the German yen, the pound dollar, the dollar loonie, the dollar Swissy, the Aussie dollar, and the Kiwi dollar. Cool, right? What are the currency crosses? Currency crosses or crosses are the more frequently traded currencies that do not include the US dollar in their pairing. Crosses include the euro pound, euro loonie, pound yen, euro Swissy, and the euro yen ATC. How many currency pairs exist? There are hundreds of currency pairs in existence, but not all can be traded in the forex market. The United Nations currently recognizes 180 currencies. If you were to pair each currency up with another, it's a lot. Did you know there are 180 legal currencies in the world as recognized by the United Nations? That's a lot of potential currency pairs. Unfortunately, not all of them are readable. Forex brokers tend to offer traders up to 70 currency pairs. Forex market size and liquidity. The bulk of forex trading takes place on what's called the interbank market. Unlike other financial markets like the New York Stock Exchange or London Stock Exchange, the forex market has neither a physical location nor a central exchange. The forex market is considered an over-the-counter OTC market due to the fact that the entire market is run electronically within a network of banks, continuous over a 24-hour period. This means that the forex market is spread all over the globe with no central location. Trades can take place anywhere as long as you have an internet connection. The forex over-the-counter market is by far the biggest and most popular financial market in the world, traded globally by a large number of individuals and organizations. In an OTC market, participants determine who they want to trade with depending on trading conditions, the attractiveness of prices, and the reputation of the trading counterpart, the other party who takes the opposite side of your trade. The chart below shows the 7 most actively traded currencies. And here it is. Currency distribution in the forex market. As you can see, the US dollar is 84.9%, euro 39%, Japanese yen on 19, Great British House about 12.9, the Australian dollar 7.6, Swiss franc 6.4, Canadian dollar 5.3, and all the others combined at 25%. Because two currencies are involved in each transaction, the sum of the percentage shares of the individual's currencies totals 200% instead of 100%. The US dollar is the most traded currency, making up 84.9% of all transactions. The euro shares is second at 39.1%, while the yen is third at 19.0%. As you can see, most of the major currencies are hugging the top spots in this list. The dollar is king in the forex market. You've probably noticed how often we keep mentioning the US dollar. If the US dollar is one half of every major currency pair, and the majors comprises 75% of all trades, then it's a must to pay attention to the United dollar. The US dollar is king. So currency composition of world forex reserves. So this is a pie chart showing the currency compositions of world forex reserves. Again, the US dollar is king. In fact, according to the International Monetary Fund, the IMF, the US dollar comprises roughly 62% of the world's official trading exchange reserves. Foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. Because almost every investor, business and central bank own it, they pay attention to the US dollar. There are also other significant reasons why the US dollars play a central role in the forex market. The United States economy, is the largest economy in the world. The US dollar is the reserve currency of the world. 3. The United States has the largest and most liquid financial markets in the world. 4. The United States has a stable political system. 5. The United States is the world's sole military superpower. And 6. The US dollar is the medium of exchange for many cross-border transactions. For example, oil is priced in US dollar, which is also called petrodollars. So if Mexico wants to buy oil from Saudi Arabia, it can only be bought with the United States dollar. If Mexico doesn't have any dollar, it has to sell its peso first and buy the US dollars. Speculation in the forex market. One important thing to note about the forex market is that while commercial and financial transactions are part of the trading volume, most currency trading is based on speculation. In other words, most of the trading volume comes from traders who buy and sell based on the short-term price movements of currency pairs. The trading volume brought about by speculators is estimated to be more than 90%. The scale of the forex market means that liquidity, that's the amount of buying and selling volume, happen at any given time, is extremely high. This makes it very easy for anyone to buy and sell currencies. From the perspective of a buyer, liquidity is very important because it determines how easily price can change over a given period. A liquid market environment like Forex enables huge trading volumes to happen with very little effect on the price or price action. While the Forex market is relatively very liquid, the market depth could change depending on the currency pair and time of day. In our Forex trading sessions part of the school, we explain how the time of your trades can affect the pair you are trading. In the meantime, let's learn about the different ways that individuals can trade currencies. Different ways to trade Forex. Because Forex is so awesome, traders come up with a number of different ways to invest or speculate on currencies. Among the financial instruments, the most popular ones are retail Forex, spot FX, currency futures, currency option, currency exchange traded funds or ETFs, Forex CFDs, and Forex spread betting. It is important to point out that we are covering the different ways that individual retail traders can trade Forex. Other financial instruments like Forex swaps and forwards are not covered since they cater to institutional traders. With that out of the way, let's now discuss how you can partake in the world of Forex. So, currency futures. Futures are contracts to buy or sell a certain asset at a specific price on a future date. That's why they are called futures. A currency future is a contract that details the price at which a currency could be bought or sold and sets a specific date for the exchange. Currency futures were created by the Chicago Mercantile Exchange, the CME, way back in 1972. Where bell bottoms and platform booms were still in style. Since futures contracts are standardized and traded on a central exchange, the market is very transparent and well regulated. This means that price and transaction information are readily available. Currency option. An option is a fundamental instrument that gives the buyer the right or option but not the obligation to buy or sell an asset at a specific price on the option's expiration date. If a trader sold an option, then he or she will be obliged to buy or sell an asset at a specific price at the expiration date. Just like futures, options are also traded on an exchange such as the Chicago Mercantile Exchange, the CME, the International Security Exchange, ISE, or the Philadelphia Stock Exchange, PHLX. However, the disadvantage in trading FX option is that market hours are limited for certain options, and the liquidity is not nearly as great as the futures or spot market. Currency ETFs. A currency ETF offers exposure to a single currency or basket of currency. Currency ETFs allow ordinary individuals to gain exposure to the forex market through a managed fund without the burdens of placing individual trades. Currency ETFs can be used to speculate on forex, diversify a portfolio, or hedge against currency risks. Here's a list of the most popular traded currency ETFs. ETFs are created and managed by financial institutions that buy and hold currencies in a fund. They then offer shares of the fund to the public on an exchange, allowing you to buy and trade these shares just like stocks. Like currency options, the limitation in trading currency ETF is that the market isn't open 24 hours. Also, ETFs are subject to trading commission and other transaction costs. The spot FX. The spot forex market is an off-exchange market, also known as over-the-counter market. The off-exchange forex market is a large, growing and liquid financial market that operates 24 hours a day. It is not a market in the traditional sense because there's no central trading location or exchange. In an over-the-counter market, a customer trades directly with a counterparty. Unlike currency futures, ETFs, and most currency options, which are traded through centralized markets, spot forex are over-the-counter contracts, that is, private agreements between two parties. Most of the trading is conducted through electronic trading network or telephone. The primary market for Forex is the inter-dealer market, where Forex dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currency at any time with its clients. The inter-dealer market is also known as the interbank market, due to the dominance of banks as Forex dealers. The inter-dealer market is only accessible to institutions that trade in large quantities and have a very high net worth. These include banks, insurance companies, pension funds, large corporations, and other large financial institutions that manage the risks associated with fluctuations in currency rates. In the spot forex market, an institutional trader is buying and selling an agreement or contract to make or take delivery of a currency. A spot forex transaction is bilateral, that's between two parties' agreement to physically exchange one currency against another currency. This agreement is a contract. This means this spot contract is a binding obligation to buy or sell a certain amount of foreign currency at a price that is the spot exchange rate or the current exchange rate. So if you buy Euro USD, that's Euro dollar, on the spot market, you are trading a contract that specifies that you will receive a specific amount of euros in exchange for dollars at an agreed upon price or exchange rate. It's important to point out that you are not trading the underlying currencies themselves, but a contract involving the underlying currencies. Even though it's called spots, transactions aren't exactly settled on the spot. In reality, while the spot forex trade is done at the current market rate, the actual transaction is not settled until 2 business days after the trade date. This is known as T plus 2, which is today plus 2 business days. This means that delivery of what you bought or sell should be done within 2 working days and is referred to as the value date or delivery date. For example, an institution buys Euro USD in the spot forex market. The trade opened and closed on Monday, has a value date on Wednesday. This means that it will receive euros on Wednesday. Not all currencies settle T plus 2 though. For example, USD CAD, that's the dollar loonie, United States dollar TRY, the US dollar rupee, and the US dollar PHP. Value date is T plus 1, meaning 1 business day going forward from today. Trading in the actual spot forex market is not where retail traders trade though. Retail forex. This is a secondary OTC market that provides a way for retail, that's poorer traders, to participate in the forex market. Access is granted by so-called forex trading providers. Forex trading providers trade in the primary OTC market on your behalf. They find the best available prices and then add a markup before displaying the price on their trading platforms. This is similar to how a retail store buys inventory from a wholesale market, adds a markup, and shows the retail price to their customer. Although a spot forex contract normally requires delivery of currency within 2 days, in practice, nobody takes delivery of any currency in forex trading. The position is rolled forward on the delivery date, especially in the retail forex market. Remember, you're actually trading a contract to deliver the underlying currency rather than the currency itself. It's not just a currency contract, it's a leverage contract. Retail forex traders can't take or make delivery on leveraged spot forex contracts. Leverage allows you to control large amounts of currency for a very small amount. Retail forex brokers let you trade with leverage, which is why you can open positions valued at 50 times the amount of the initial required margin. So with $200, you can open a Euro USD trade valued at $10,000. Imagine if you went short, that which you sold the Euro US dollar and had to deliver 10,000 worth of euros. You'll be unable to settle the contract in cash since you only have $200 in your account. You wouldn't have enough money to cover the transaction. So you either have to close the trade before it settles or roll it over. To avoid this hassle of physical delivery, retail forex brokers automatically roll client positions. This is how you avoid being forced to accept or deliver 10,000 euros. Retail forex transactions are closed out by entering into an equal but opposite transaction with your forex broker. For example, if you bought British pounds with your US dollar or with the US dollar, you will close out the trade by selling British pounds for US dollar. This is also called offsetting or liquidating a transaction. If you have a position left open at the close of the business day, it will automatically roll over to the next value date to avoid the delivery of the currency. Your retail forex broker will automatically keep on rolling over your spot contract for you indefinitely until it is closed. The procedure of rolling the currency pair over is known as tomorrow next or tom next, which stands for tomorrow and the next day. When positions are rolled over, this results in either interest being paid or earned by the trader. These charges are known as a swap fee or rollover fee. Your forex broker calculates the fee for you and will either debit or credit your account balance. Retail forex trading is considered speculative. This means traders are trying to speculate or make bets and profit from the movement of exchange rates. They are not looking to take physical possession of the currencies. They buy or deliver the currencies they sell. So, forex spread bet. Spread betting is a derivative product, which means you don't take ownership of the underlying assets, but speculate on whichever direction you think its price will move up or down. A forex spread bet enables you to speculate on the future price direction of a currency pair. A currency pair price being used on the spread bet is derived from the currency pair's price on the spot forex market. Your profit or loss is dictated by how far the market moves in your favor before you close your position and how much money you have bets your points of price movement. Spread betting on forex is provided by spread betting providers. Unfortunately, if you live in the US, which most of us don't, spread betting is considered illegal, good for us. Despite being regulated by the FSA in the UK, the US considered spread betting to be internet gambling, which is currently forbidden in the United States. Forex CFD. A contract for difference, which is the CFD, is a financial derivative. Derivative products track the market price of an underlying asset so that traders can speculate on whether the price will rise or fall. The price of CFD is derived from the underlying asset price. A CFD is a contract typically between a CFD provider and a trader, where one party agrees to pay the other the difference in the value of a security. between the opening and closing of the trade. In other words, a CFD is basically a bet on a particular asset going up or down in value, with the CFD provider and you agree that whoever wins the bet will pay the difference between the asset's price when you enter the trade and its price when you exit the trade. A Forex CFD is an agreement or contract to exchange the difference in the price of a currency pair for when you open your position versus when you close it. A currency pair CFD price is derived from the currency pair price on the spot FX market, or at least it should be. If not, what is the CFD provider basing its price on? Trading Forex CFDs give you the opportunity to trade a currency pair in both directions. You can take both long and short position. If the price moves in your chosen direction, you will make a profit. If it moves against you, you will make a loss. In the EU, that's European Union and UK, United Kingdom, regulators decide that rolling spot FX contracts are different from the traditional spot FX contracts. The main reason being is that with rolling spot FX contracts, there is no intention to ever take actual physical delivery, that's take ownership of a currency. Its purpose is to simply speculate on the price movement in the underlying currency. The objective of trading a rolling spot FX contract is to gain exposure to price fluctuations related to the underlying currency pair without actually owning it. So to make this difference clear, a rolling spot FX contract is treated as a CFD. In the United States, CFDs are illegal as is known as a retail forex transaction. CFDs are illegal, so it is known as a retail forex transaction. Forex CFD trading is provided by CFD providers. So as outside of the United States, retail forex trading is usually done with CFDs or spread bets. When a spot forex transaction is only physically delivered, when a spot forex transaction is not physically delivered, but just indefinitely rolled forward until the trade is closed, it is known as a rolling spot forex transaction or rolling spot FX contract. In the United States, the CFTC calls it a retail forex transaction. Forex trading providers are also known as forex brokers. Technically, they are not brokers because a broker is supposed to simply act as a middleman between a buyer and a seller, as between two parties. But this is not the case because a forex trading provider acts as your counterparty. This means if you are the buyer, it acts as a seller, and if you are the seller, it acts as the buyer. To keep things simple for now, we will still use the term forex broker, since that's what most people are familiar with. But it's important to know the difference. At this point, we've come to the end of part 1. Remember, we still have about 8 more parts to go. Just so we can be clear, again, these are my details in which you can use to follow me, contact me, or make an inquiry. But for now, we shall keep our class simply to WhatsApp. You can as well follow me on the following platform and see my details. But for now, this class is strictly meant for WhatsApp only. Hope you've learned 1 or 2 things about what is Forex. See you in the next video. Thank you.